Before we start, do not forget to like and subscribe to the channel and press the bell to receive all new updates. Finance management is the strategic planning and managing of an individual or organization's finances to better align their financial status to their goals and objectives. Depending on the size of a company, finance management seeks to optimize shareholder value, generate profit, mitigate risk, and safeguard the company's financial health in the short and long term. When working with individuals, finance management may entail planning for retirement, college savings, and other personal investments.
The objective of financial management. Modern financial management theory assumes that the primary objective of a business is to maximize the wealth of its shareholders. Maximizing shareholder wealth means maximizing the flow of dividends to shareholders through time. This is a long-term perspective. Profit maximization is not the same as shareholder maximization.
Profit is a concept developed by accountants to aid decision-making, one decision being to judge the quality of stewardship shown over the owner's funds. Profit can be increased simply by making use of more shareholders' money. Suppose shareholders inject more money into the company or merely retain profits, which belong to shareholders. In that case, their future profit can rise. But the return on shareholders' money may fall into less than what is available elsewhere for the same level of risk.
The role of financial manager.
Financial planning.
Manager need to assess the potential impact of proposals on future financial performance and position. These can often take the form of projected financial statements, such as projected cash flow statements and projected income statements.
Investment project appraisal. By undertaking appraisals of the profitability and riskiness of investment project proposals, managers can make informed decision about whether to accept or reject them. These appraisals can also help in prioritizing investment projects that have been accepted. Financing decision. An appropriate balance must be struck between short and long-term financing sources and between the contribution of shareholders, owners, and that of lenders. An essential source of internally generated finance is profits. And the extent to which these are reinvested within the business, rather than distributed to the owners, requires careful consideration. Capital market operations. Managers will often seek advice and guidance on how finance can be raised through capital markets. How securities, shares and loan capital are priced. And how the markets are likely to react to proposed investment and financing plans. Financial control. Once plans are implemented, managers must ensure that things stay on course. Regular reporting on information on actual outcomes, such as the profitability of investment projects, level of working capital and cash flows, plays a vital role. Financial management versus corporate finance. Financial management is also known as corporate finance. It focuses on decision relating to how much and what types of assets to acquire, how to raise the capital needed to buy assets, and how to run the firm to maximize its value. The same principles apply to both for-profit and not-for-profit organization. Financial report. A company's annual report usually begins with the chairperson's description of the firm's operating results during the past year and discusses new developments that will affect future operations. The annual report also presents some basic financial statements underscore the balance sheet,
the income statement, and the statement of cash flows.
The quantitative and qualitative written materials are equally important. The financial statements report what has happened to assets, earnings, dividends and cash flows during the past few years. Whereas the written materials attempt to explain why things turned out the way they did.